Okay, once again, a short video. This will be the last one on cross-border sales in the internal market of the EU. And, well, as I mentioned at the end of the last video, the fact that sometimes goods can be taxed in the country of origin in the single market can lead to problems. And also, in other cases, there might be some results where some unpleasant details result from the rules, so that there are some modifications of the basic rules for some peculiar special cases. So, some constellations exist where, apart from the three alternatives, there are some modifications to the basic rules. These cases are, to my knowledge, cross-border sale of new vehicles, that is, cars, ships, and aircrafts. The EU cross-border sale of excise duty goods, so excisable goods, alcohol, mineral oil, tobacco, and the cross-border sale to diplomatic and similar institutions and to certain parts of armed forces. The intra-community transfer of goods, which we have already discussed above within the general system, and the trade of concerning gold for investment purposes. Well, just let's give an overview, because we probably will never concentrate on these very special cases in our real life, but you should at least know about the existence of them. So, for new vehicles, especially for new cars, the usual system of taxation, so that if you go, let's say, to the country where the vendor lives, and knock on the door there, buy the vehicle and go home, that this would be taxed in the country of origin. That would quickly lead to enormous distortions in the market. I can easily show you what would happen. So imagine you have a Danish private customer, 25% is the tax rate in Denmark, who thinks about buying a new car, and the net value of the new car shall be 30,000 euro. Now, what would be the situation under the normal rules for the internal market? Well, you have the Danish customer, you have the Danish car trader, you have the Danish customer asking the car trader how much will it cost. Car trader says 30,000 plus 25%, 37,500. You have a Luxembourgish car trader. Danish customer says how much. The Luxembourg car trader says, well, 30,000 plus 17%, 35,100 would be the price. Now Danish customer says yes. Clap, clap. So Danish car trader is out. But condition is that Danish customer in person travels to Luxembourg, takes a car and drives home. Now we have to ask ourselves, would an average Danish customer, or would you as an average customer from another country, just in order to save 2,500 euro in the price of an important new acquisition, would you for that financial advantage take 2 days of a holiday, travel to another country and drive home in a newly acquired car? And the answer is yes, you would. Now, if it's only a car for 20,000, then the financial advantage would probably be lower. 8% of 20,000 is only 1,600. But then imagine your salary is probably also lower. So what 2,400 euro is for somebody who can buy a car with a net value of 30,000, that is 1,600 euro for somebody who can only afford a car with a net value of 20,000. So everybody will be motivated to take 2 or 3 days off, travel to Luxembourg. The cost of the travel will probably come off, and you have still some net outcome. And you only buy these vehicles every 5, 6, or 8 years. So it also doesn't require constant traveling. So, what would be the fate of all Danish car traders in such a system? The answer can be easily seen. They have no chance to survive, swinging on a gallows, hanged by themselves in the dark. So, if you want to avoid that, and under that system, which I just outlined, is that result unavoidable? Then why is it unavoidable? Well, cars and similar objects are extremely expensive. So the tax rate difference really here leads to a great outcome for the people who exploit the system. And that motivates people to undertake a travel just because of that acquisition. And what comes on top, cars, new ships and aircrafts can easily be transported. So it's absolutely easy to transport these things home. When you buy new furniture in Palermo in the south of Italy and you need it in Finland, that's far different. Then the transportation costs will probably outweigh the tax rate difference. But well, vehicles are there for travel, so it's very, very easy and you would do it. So we needed a special tax regime for new vehicles. You can limit that special regime to vehicles which are new, because when you buy a second-hand vehicle, there are already enough differences in the product which are relevant for the market between the offer of a foreign supplier and a local supplier. For example, buying second-hand is always a matter of trust. If you buy from somebody who is far, far away and you have some complaints, you would have to travel to that trader far, far away, and then the employee of that trader would tell you the boss is not here and I can't decide it, please come again next time. So complaining would be highly difficult and expensive, and that is why a reasonable person usually would not buy a second-hand car, especially not from a faraway trader, especially not under or in a different country under a potentially different legal system, which makes complaints unforeseeable, or the outcome of complaints. So that's a problem. So we can say we do it for new vehicles. Now, if for old vehicles the special regime does not apply, one necessarily needs to close loopholes by which a car or other vehicle could be artificially turned into an old one. For example, a car, that's one of the rules, is no longer new if a period of more than 6 months has passed since its first registration. So a clever car trader would probably register it, place it into a garage, close the garage, doesn't touch it for 7 months, open the garage afterwards, take the car out, and now sell it as old. For this reason, the second condition is post. A car, in addition to that first condition, is only regarded as old if it has been driven for a given minimum amount of kilometers. So putting it into the garage and not using it does not help anymore. So you have to pass two conditions, two limits, before a car or another vehicle is old. Usually it's a combination of how far away in the past it's the first registration, plus how many kilometers or other performance the car or the vehicle has already been used for. Same idea, other data. Okay, now what can we do? The special regime which you establish for new vehicles can be based on a very easy principle. The problem is you tax it in the country of origin. So to solve the problem, the solution must be you tax every new vehicle in the country of destination. So every cross-border purchase of a new vehicle within the EU is taxed as an intra-community acquisition. And now, surprise, even if the acquirer is not an entrepreneur, but a private person. Now, we have always said that with a private person, you can't do that. You can't demand intra-community acquisition declarations from them. You can't check what they bought. They are too stupid to learn it and all that. Especially, you can't supervise the whole stuff. But now with vehicles, you have a possibility to supervise what has happened. Everybody knows that every vehicle must be registered with a state authority in the state where the customer lives. And on that occasion, the authorities will see where the vehicle has been registered before or where it comes from. So you see that the vehicle has not yet been registered in the inland before. You see that it has been owned or delivered by somebody else outside the country. And then the registration authorities can just write a letter to the fiscal authorities, and the fiscal authorities do the rest. They ask you which price did you pay, and this is automatically then a net price because it's an intra-community acquisition. You have to pay 19% or which tax rate your country ever has on top of the price. So the taxation in the country of destination can hereby easily be ensured in that particular case of private persons and new vehicles. Here it's technically possible, so you can do it. Well, if you look through the conditions for intra-community acquisition, then you see normally, okay, first condition, the good must cross the border. That's the case here. That's easy. That's still a requirement. The vehicle must have been in another member state and now comes in. But the acquirer normally should be an entrepreneur. The deviation is now every acquirer of a new car, even if a private person has to pay intra-community acquisition tax. But there is usually a third condition. Usually a transaction is only taxable if the seller has also been an entrepreneur. And this is again a loophole, because one could easily avoid the application of the new tax regime for new vehicles if you have them sold by private persons. Now you would think, how could private persons sell a new vehicle? And the answer is, well, imagine creative people. If the Luxembourgish seller gets the information he can't exploit the Danish market so easy, his customer will have to pay acquisition tax, then a clever Luxembourg trader would say, well, here's my car. I can't sell you this car at the low Luxembourgish price, but my neighbor can. And for this reason, I sell this to my neighbor, and the neighbor drives it for 6 months or even less. Now you would say that's tax abuse, that's you could mask it. For example, it would be highly attractive for Luxembourgish private persons to buy a new Mercedes car, drive it for 2 months, and then place it on the internet. Who wants to buy a second-hand car from Luxembourg, nearly absolutely new, make a small profit, and then buy a new one? So you would probably drive your car for free because the Danish customer would still pay a price which is a bit higher than the price which you pay to the Luxembourgish trader. Everybody would be happy, perhaps. So the Luxembourgish trader would be able to sell for 35,100, and the private person in Luxembourg would afterwards sell second-hand to the Danish customer after some 3 months or so, let's say at 36. So for the Danish customer, it's still far cheaper than buying a thing in Denmark. And you know, cars are often sold after 1 year or 2 years, and people are happy because they are in excellent state, these cars, and you pay a slightly lower price and you get them immediately. You don't have to wait for the order so long. So happiness everywhere. The only person who is again unhappy is the Danish car traders, because for them the outcome is again clear what will happen. dangling in the wind on a rope, in the dark, on a tree, or on a lantern in the street, or where else. They have no chance to survive if such a second-hand market for nearly new cars is allowed to evolve. And so, by deviation from the normal rules, the solution is just, if the problem which we have is that the supplier must be an entrepreneur, otherwise the acquisition is not taxable, then we just change the conditions here. In case of a new vehicle, not only every acquirer is treated as a taxable acquirer, but additionally, every seller who sells a still new vehicle into another EU country is automatically treated as having the status of an entrepreneur for that in particular transaction. So that person performs automatically an intra-community delivery. The only exception which you make is that private person is not allowed and not required to hand in a recapitulative statement, because both persons are private in that constellation. Nobody of them has a VAT identification number, and none of them needs one, because we can check the transaction via the registration authorities. So the seller gets the status of an entrepreneur. That deprives the acquirer of talking himself out of taxability with pointing out that the seller was not an entrepreneur. For the private person who sells a car and this car is new, well, how can you find them? And the answer is you don't need to. The private person has an intra-community delivery, so for them there will be no tax. So the entrepreneurial status has no negative consequences for them. The only consequence would be an advantageous one, because our Luxembourgish seller, if qualified as an entrepreneur, would be able to claim the VAT for his own purchase of the car back now as input tax. And that is systematically necessary, because otherwise you would have, in case where a private intermediate owner enters into the chain, you would have Luxembourgish VAT becoming a definitive tax, and then again Danish VAT becoming definitive. Then you would ruin the market here. In cases where you have a bona fide transaction, it would ruin the market by a double taxation, and you don't want that. You want to have a proper one-time transaction taxation. So you grant that seller the VAT input tax deduction for his own transaction at the moment when it's clear that he becomes an entrepreneur for that transaction, in order to be fair. So, however, when you give the input tax to a private seller of a new car, the input tax VAT can only be claimed when it's clear that this happens. So only when the private person sells on the car to Denmark, then you can indeed see that for this transaction our friend is an entrepreneur, and so he can only claim the VAT back in the moment when he sells on to another member state. So not then, but only later. Well, that makes sense. Otherwise, the Luxembourgish guy would claim the VAT, immediately drive a completely untaxed car through Luxembourg, and after 6 months probably nobody would remember to ask him what happens to the car. So only when the resale takes place. Well, now there is still another modification or another loophole where you have to think about. If every private person who resells his car within 6 months to another member state can reclaim the input tax, that can be highly attractive in cases where you have really bad luck. Imagine this: you have a Luxembourgish trader, he buys a car, he sells a car to a Luxembourgish private person. Now, Luxembourgish private person is a bit drunk or is a bit old, 96, or is 96 and is heavily drunk. So the outcome is drives like a complete idiot, has a brutal crash after 2 days after he bought the car. So the value of the car drops considerably down. And you have now a completely crashed car, and the remaining value of the car is only 1,000 euro. Now imagine our Luxembourgish private person is a tax advisor or has a good tax advisor, and tax advisor says, hey, sell that rubbish to a Danish private customer or to a Danish trader, because what you do now is you sell a new car to another member state. So you sell off the rubbish, the remains of the car must still be a car. If it still drives, it is still a car. You sell that off to Denmark, that makes you into an entrepreneur, and then you claim back the input tax on the original amount of money, on the original 5,1. So you could recover after the crash 5,100 plus 1,000. But normally you would never have deserved these 5,1 because what you sold on was not the original car. It was just the sorry and sad remains of that car. So, and the sale evidently only happened in order to be able to claim back the VAT. So that must be avoided. Well, how can you now interpret the drop down in the value from 30,000 net to 1,000 net? Well, you can say that drop down in the value was due to private consumer activities driving the car in a very original way, and 29,000 were gone. So if it was due to private consume, you should not be relieved of VAT, referring to that drop down in value, to that consumption of value. And that is the key to the final solution here, because for that reason the input tax of a private person which sells on a still new vehicle is limited to, at maximum, to that VAT which would correspond under the countries of the state, under the laws of the state of origin, to the net price which can be obtained from selling it on. In our previous example, that would mean the VAT burden at the first purchase of the car was 5,1. Now the net price when you resold it was 1,000 only. The VAT burden, which corresponds in Luxembourg to 1,000 net price, is 170 euro. That's 17%. And so your input tax refund claim would be limited to that amount. So from the 5,100 you would only get 170 euro back. All the rest of the VAT would be deemed to have been consumed, or referring to the consumption activities which you had in the first 2 days, to slightly changing the outer appearance of that car and thereby turning it into a ruined car. This is consumption, and so it should not be relieved of tax. So that's the reason why when it comes to input tax rules, you will find a special rule referring to the input tax claim of some private person who sells a new vehicle into another member state. So where will these legal rules, or where are these principles placed into the law? The first principle is every buyer of a new vehicle always will have to pay inter-community acquisition tax. If the buyer is already an entrepreneur, that's no problem. You can use the regular rules and you are bound to use them. 1A USDG, it is an intra-community acquisition under the normal rules, no problem. If the buyer is a half entrepreneur, the intra-community acquisition normally depends on surpassing a threshold. Now the simplest way out to solve the problem is just to say a half entrepreneur who buys a new vehicle from another member state, for that transaction, the threshold doesn't count. You always are taxable. And for buyers who are neither entrepreneurs or half entrepreneurs, you just write an additional rule which says even these people have always to pay intra-community acquisition tax. Paragraph 1b USDG says this, and it only applies to these cases. 1b is buyer is private. Okay. And now the second rule, every seller will be regarded as an entrepreneur. That principle makes no problem if the seller really is an entrepreneur. Then you just use paragraph 2.1 like always. If the seller is, however, a private person, you need that fiction, and that comes immediately afterwards in paragraph 2a. In cases where the seller of a new vehicle is not an entrepreneur, he or she is deemed to be an entrepreneur. Full stop, finished, all out and over. And then with regard to the input tax claims of that person, you will just set a limit to the input tax claims and will say they can only claim it when it's clear that they fulfill the requirements. So when they do the resale into another member state, that will be found in paragraph 15.4a. So in paragraph 15 you have in Germany the rules on the input tax claims, and there you find that detail. Good. So you have already now an insight into the most complicated and fascinating special rule for certain goods within the internal market. And now let's turn to another peculiarity. Now the next group where special rules are necessary, or at least convincing, is excise tax relevant goods, or excisable goods. An excise tax is an indirect tax which is levied on a specific kind of good. So, for example, tobacco tax, fuel tax, tax on alcohol, all these taxes are excise taxes. And for these taxes, there is a similar system established for cross-border deliveries as for VAT. So you also have that rule that if the buyer of an excisable good buys something, the buyer is responsible to pay the excise tax and not the seller. You have also that second step. If the buyer is an idiot, then the seller must pay in the country where he sends the good to. And you have then the default option. If the buyer comes to your shop and just take the good home, then nothing happens. Well, but there is a peculiarity. There are no thresholds for excise taxes. So every entrepreneur and every half entrepreneur is bound to pay excise taxes in the country of destination. No tolerance, no threshold, not a single euro. So the acquisition threshold for half entrepreneurs is not relevant for excise taxes. Now imagine what would happen if you tell somebody, well, if you as a half entrepreneur buy a single package of tobacco from another member state, you need to buy tobacco tax, to pay tobacco tax. That's highly complicated. You only have very few specialized tax advisors probably who are able to do it. And then you just say that to that person, well, but you don't need to pay the VAT on that. That can be done by the seller in his own country, or because, we want to save you the bureaucratic effort. Probably the buyer would not understand your strange sense of humor. If somebody is forced to pay tobacco tax, then the tax advisor of that person can easily also fill out a VAT tax declaration. Because in comparison to tobacco tax obligations, VAT is a joke. And so it makes no sense to grant a threshold in cases of an excisable good. Furthermore, mentioning in the VAT Act that excisable goods have no threshold, also for VAT, brings that the existence of these excise taxes back into the memory of all average tax advisors. They know now with cross-border delivery of tobacco or fuel or other things, there is something special and they should probably ask an expert, because otherwise it might be forgotten. Somebody who never has to do with tobacco tax probably doesn't wake up when cigarettes are sold cross-border in to a customer who normally doesn't buy them. Here, the rule which says there is no threshold for buyers who buy excisable goods wakes up every tax advisor, and then they don't forget that there is also an excise duty problem. The same is in case of the OSS scheme. Also there, threshold will not apply. So the only rule which you need to keep in mind for excisable goods is that for their acquisition, the acquisition threshold does not apply. And for cross-border sales, probably the other threshold also doesn't apply. And now you still need to know that as the rules are harmonized in the EU, the term excisable goods for VAT purposes only covers those excise taxes which exist in all states of the EU and which are prescribed by European Union law to have a certain minimum level. That is mineral oil, alcohol and alcoholic drinks, and tobacco. Other excise taxes, for example, the German strange excise tax on coffee, are not covered by the rule. Although they are an excise tax, they don't qualify as excisable goods in the sense of the VAT rules. Well, next strange case, where a deviation from the normal rules is necessary. The normal rules say juridical persons who do not run an enterprise can nevertheless become a taxpayer for the intra-community acquisition tax if they buy goods from other member states and surpass a threshold, either last year or this year. Now, the problem with that rule is that after a while, the legislator in Europe found out that this definition, if you take it word by word, also applies to an embassy of a foreign state, and or to some international institution residing in the inland, to armed forces of other contracting states of NATO, and blah blah, and so on. Now, the problem is these international institutions or these embassies are usually not taxable under international law. So you can't make them into taxpayers, or you can say they are taxpayers, but you have no chance to ever collect the tax because they are free from any authority of the guest state. So you can't treat them as taxable acquirers. And so delivering goods to them cannot be treated as intra-community delivery and intra-community acquisition on the one and other side. You need to clarify that, and that is what can be found in paragraph 1c, subparagraph 1. It's sheer logic. Naturally, if you have an acquirer which is a juridical person, has a bookkeeping, but cannot be subjected to your tax authority, you have to regard it as somebody who doesn't qualify as a reasonable taxpayer. You must qualify them like a private person and have to change over to solutions number 3 and 2. Paragraph 1c also covers another case where the normal rules bring along some problems, because 1c1 covers genuine intra-community acquisitions in form of a sale. But you remember there was also a second case, constellation, that was the intra-community transfer of a good from one state to the other, which before and beyond the border remains your property, same owner. In that case, somebody who could read and write, an entrepreneur and a half entrepreneur having the status of an entrepreneur, was demanded to pay acquisition tax. At least half entrepreneurs who are also entrepreneurs, perhaps not every juridical person. Well, now, under normal circumstances, as I just said, an inter-community transfer of a good can only be taxable if it's undertaken by an entrepreneur. Now, there might be juridical institutions not being an entrepreneur, but performing acquisitions to a very, very high extent. So, for example, the German armed forces. And to prevent distortions of competition, probably, after a while, the legislator said, okay, if the armed forces transfer goods from other member states into the inland, and these goods have not been taxed with the VAT of the other member states and not been taxed with importation tax, then the transfer of such goods into the inland has still to be treated as an intra-community acquisition. That wants to avoid that completely untaxed goods are owned by the army, which would distort competition in comparison to goods which are imported from third states or which are produced in the inland and then sold to the armed forces at a gross price. Well, so a peculiarity, strange, hear it, remember it when you need it, and for all other occasions, forget it. Yeah, that's a good idea to remind you of the peculiar thing, the intra-community transfer of goods in general. As we have already said, an enterprise must declare the mere transfer of a good cross-border, without change of ownership, from the territory of one EU member state into the territory of another one, as if that good had been sold for the current market value from yourself in the first state to yourself in the second state, so that you deregister it from your books in state 1 and re-register it into your books in the new state where it is. How that transfer must be treated under the law is to be seen here. The inter-community delivery in the state of origin is to be found in 3.1a, which says inter-community transfer of a good is treated like a fictitious delivery. 3.6, as always, 1.1 number 1, as always. 6a2 says intra-community transfer is always an intra-community delivery. And 4 number 1 letter B says this is always tax-free if the recapitulative statement has been correctly issued. In the state where the good goes to, there will be an intra-community acquisition of the same good. 1a2 says intra-community transfer of a good is treated as an intra-community acquisition. The place where that has to be taxed is 3d sentence 1. It's taxable under 1.1 number 5, which says intra-community acquisitions in the inland are taxable. There will be no tax exemption in 4b. The tax base is, as there is no amount paid, necessarily the minimum tax base of ton 4 number 1. And if you are an entrepreneur, you can probably also then claim input tax again, 51 number 3. And you remember the whole maneuver only serves to follow the fate of the goods which belong to an enterprise in the books without any gap, so that enterprise property can never be sold without that the sale is detected and can be followed up. The only thing which we did not yet mention clearly is that intra-community acquisition is not the case when the good is only transferred temporarily between member states. So if a good, let's say a business car, only enters the territory of another state for 3 or 4 days, then this is definitively not an intra-community acquisition and intra-community delivery. Because the underlying idea is if a good was here and when the inspector comes, the good is no longer here, you need to answer questions and to give proofs what happens with the good. And you need to prove that if the good vanished from Germany, it entered the books in another member state. Now, if a good is only on the way in another member state, let's say for a short term, 2 weeks or 2 months, and an inspector comes and says, where is that crane which you have in your books? And you say at the moment it is in France, and the inspector says how long? And you say next week it comes back. Then the inspector can naturally say, and that is the easiest solution, okay, then I have a look again on that crane end of next week. So you can solve the problem only if the intra-community transfer is for a longer time or definitively, so that the good never comes back. For example, if it's then afterwards sold in the other country, then it has to be declared. If a transfer of a good is first intended to be only temporary, but then becomes definitive, for example, if the good is destroyed in the other country, stolen there, or sold there to a customer which surprisingly shows up and buys it there, then an intra-community transfer has to be declared in the moment when it becomes clear that the transfer has become definitive. Okay, so you know now again this peculiar case of an intra-community delivery and acquisition. Number 5, a strange case too, selling gold for investment purposes. There are special rules too. Under them, the sale of gold for investment purposes is treated tax-free. That rule is not restricted to cross-border transactions, but the internal market makes it necessary, definitively. Because imagine selling good for investment purposes were liable to tax, then we would be facing a similar situation like the situation with the new vehicles. Private persons could go and buy investment gold. Denmark at 25%, Germany at 19%, Luxembourg at 17%. Where would they buy it? Naturally in Luxembourg. So it would be evident that under such circumstances, private persons would travel and buy it only in the state with the lowest tax rate. You would have a race to the bottom. You could only avoid this by harmonizing the rate for such a good. Because here you have again the same situation, basically, like in case of the vehicles. A high amount of money and the good which you buy can easily be transported cross-border. So you need an identical tax rate. Otherwise, you have no chance, because the thing with the acquirer needs to pay. Gold does not need to be registered. You can't track it. No chance. And now you can only debate which tax rate. And well, investment gold is probably nothing where you can really say there is some consume. It's rather like savings in a bank account, and you would probably ruin the whole business if you take value-added tax. I don't know if you know, but many financial investments are free of VAT. You can see that in paragraph 4, number 8. So the most convincing solution for that particular situation for gold in the single market is just to establish a complete exemption for investment gold. However, if an entrepreneur produces investment gold or changes gold into investment gold, that person is allowed to treat a tax-free delivery of investment gold as liable to tax. If he delivers that gold to another entrepreneur for that person's enterprise, the idea is then you can still deduct input tax, and the other one gets input tax too. If you deliver tax-free investment gold, you can nevertheless deduct input tax, which you paid for the gold under certain circumstances. And surprise, if you deal with investment gold, there is not only the bureaucracy for value-added tax, but you have also to take care of all the obligations of money laundering anti-money laundering legislation, which is something where I can't give you any details. Okay, but now you know there is a particular rule for that. Know it and forget it. It's just a peculiarity. And now our overview over the rules of cross-border selling of goods in the internal market is finished, and we will have to go to other topics and perhaps exercise cases. Thank you very much for watching. Hope to see you soon again, and goodbye.